Some people enjoy growing things in the earth, and some people do not. The star of our show, Dr. Bill, is someone who has a little bit of a green thumb. Maybe it's because he grew up around farming, but for the last several decades, because he lives in the city now, he has kept a small garden in one corner of his backyard. Hi, I'm your host, Shawn Terrell, and welcome to Dentist Puns and Money. This podcast is brought to you by Dentist Exit Planning. At Dentist Exit Planning, we help dentists within a few years of leaving clinical practice build their financial treatment plan for life after dentistry. So having a garden or trying to grow anything really is a good analogy for the next topic on the podcast, which is tax harvesting, both tax loss and tax gain harvesting. And it segues nicely with the recent topic that we've talked about, Roth IRA conversions, because Roth IRA conversions are more or less harvesting income. A Roth conversion takes deferred income that hasn't been taxed yet, and it harvests it to be realized income in the year that the conversion occurs. It's a strategic move to theoretically pay less tax over the long term, all things being equal. Capital gain or capital loss tax harvesting is similar in that it is an intentional decision to realize a gain or a loss in an investment account with the goal of lowering someone's total tax bill over their lifetime, over the long term. So, as with every tax planning decision, it's good to reiterate the tax philosophy of us with Dentist Exit Planning. And that's a philosophy that the goal is to pay the least amount of taxes over someone's lifetime, over the long term. Even if that means paying a little bit more in taxes than someone otherwise would have to in the short term, all things being equal. I like to play the long game. It's also worth mentioning that tax harvesting is probably among the most complicated topics I've ever tried to discuss on the podcast. And I debated internally whether I should even attempt it at all, but I am going to try it with the goal of trying to keep it simple and splitting the topic up into different episodes, and also trying to tell people that I just can't cover every aspect and every angle of tax harvesting in a podcast format. So if it's something that you're looking at or considering with your financial picture, just make sure that you're working with someone who is well-versed in tax harvesting, because if you give it a go, it takes a decent amount of analysis and planning to do it correctly. So with all that out of the way, just an overview for this episode, we're going to hit on what tax loss harvesting and tax gain harvesting is, and where it might show up in a dentist's financial picture, and then also when to consider doing it. And again, going to try to do it sort of at a really high level. And then in future episodes, we will dive a little bit more into how to do it and what to watch out for if you do it. So back to the garden example with Dr. Bill. 1 year with his garden, there was some rabbits that got in and ruined his vegetables before they really even had a chance to get ripe and grow. And he didn't see any sense, since the plants were sort of destroyed, trying to bring them back to life and watering and weeding them the rest of the summer, because he didn't think they were going to produce anything anyway. So he sort of, in that year, accepted the loss. He tilled up his damaged plants, and his savings, if you will, was the time, the energy, the water that he didn't waste. And maybe because it was a down year for his garden, he would have an opportunity as well to sort of prime his soil with compost and fertilizer to hopefully have a better harvest in the future, in future years. Other years, in fact, most years, Dr. Bill's garden turns out really well. He does a good job on mitigating the vermin that live in his backyard. And he usually has plenty of good stuff to pick later in the summer. So his gain in those years is the food he gets to enjoy for himself and his family, what he can share with his neighbors. And if there's really a lot, he takes some to a local food pantry to share there. And this is a good analogy for what tax harvesting is. First and foremost, tax harvesting usually applies to investment accounts that are non-qualified. So this strategy will not apply to a 401k or an IRA or a savings account under normal circumstances. A non qualified account does not receive as much preferential treatment on taxes as some of the other accounts that we just mentioned. So, if a dentist is already maxing out their 401k or their profit sharing plan, and they're also maxing out their savings options in other areas like back to Roth IRAs, maybe health savings accounts, then oftentimes a non qualified account is the next place to go if there's additional money available to save and there's a desire to get market rates of return on that additional savings. So these non qualified accounts are sometimes referred to as taxable accounts or brokerage accounts, but really they are investment accounts that are just subject to different types of taxation, like short term and long term capital gains. And these losses and these gains can thus be harvested or realized in a way that's strategic and in a way that's hopefully going to lower the overall tax bill over someone's lifetime over the long haul. So, as an example, let's say Dr. Bill takes $100,000 and puts it in a non qualified investment account. And maybe even a little bit more specifically, let's say that $100,000 features $1,000 invested separately in 100 different companies. And this further hypothetical, let's just say that after 1 year, that overall account balance has grown to $105,000. So there's a $5,000 net gain in the overall account, and there's a 5% rate of return on that for easy math. But if you look a little bit further below the surface, in most situations like that, there's going to be some companies that have done well and done better than 5%. And there's going to be other companies that have not done as well, have not had a great rate of return, but are sort of brought up by the other companies that have. So from a tax perspective, if and when the funds in that account have done well and are sold, whatever the gain is at sale or whatever the difference is between the price that the fund was bought at and what it was sold for, that gain has to be reported and is potentially taxable. On the other hand, any fund inside that account that sold for less than what someone paid for creates a capital loss, which can then be used to offset a capital gain. And if there are more losses than gains in any given year, those losses can be accumulated and carried forward to a future tax year to offset capital gains in the future, and also potentially offset a portion or lower the tax due on ordinary income in the future. Now, there's a lot of rules attached to that. This is me not getting into the weeds on that. Just be aware that there's a lot of rules with that. So, like Dr. Bill's garden, there's going to be good years and there's going to be bad years in the investment account or investments in general. And the outcome for the garden and the investment account in a given year, a lot of times, is just beyond someone's control. Someone can do everything right and have a bad outcome. So a dentist should evaluate the gains and the losses in any taxable investment accounts every year. Broadly speaking, it probably doesn't make sense to recognize and harvest gains in a dentist's peak earning years. That's because capital gains tax is largely dependent on the amount of other income that's on a tax return. So if a dentist is still working and clinical and practicing and earning good money, then that money is going to show up on the tax return, and it's probably not going to make a lot of sense to realize capital gains if you don't have to, because the opportunity for preferential tax treatment goes down if there's a lot of other income on the balance sheet. But in a year where the market is down, that might be a good opportunity to look for losses that can be realized at that time and then used to offset gains and offset income in the future. No one really enjoys seeing their account balance and their investment accounts be down when it's happening in real time. But while there's little control over that, a lot of times it might create a tax planning opportunity for the future. It's kind of like Dr. Bill's garden. Most years there's going to be plenty to harvest and an opportunity with the excess that is produced. But some years, for reasons that are beyond his control, there just isn't going to be a good crop. And that can provide a long-term opportunity as well by sort of composting or fertilizing the soil for a better harvest down the road. It's a little bit like that proverbial saying, when life gives you lemons. And while Dr. Bill doesn't grow any lemons in his garden, that doesn't mean that he can't make lemonade, especially with his taxes. So, speaking of taxes, if you would like a reference of the many rules and the current numbers in effect with taxes, we have a free tax cheat sheet that we can send you. And it includes all the changes that go into effect now that it's a new year. So, whether you're watching this on YouTube or you're listening to the podcast on one of the podcast apps, you can go to the show notes, look for episode resource. And if you click there, we will email you our tax cheat sheet. Also, if you're a dentist and you're leaving clinical in the next few years and you are interested in a personalized consultation with me with dentist exit planning, you can schedule a no obligation virtual meeting. And to do that, just go to dentistexit.com and click on free consultation on the top right corner of the homepage. One reminder before I go, and that's that Dentist Exit Planning is a registered investment advisor. The information presented here should not be interpreted as investment, legal, tax, financial planning, or wealth management advice. It's for educational purposes only, and past performance is not indicative of future results. Thanks for watching. Thanks for listening. I'm Shawn Terrell, and we will talk to you again very soon.